Get started. All right, ladies and gentlemen. So I'm Aaron Fragnito. We have Seth Martinez here as well. And we're going to talk about how to diversify your stocks into real estate. Sorry for a little technical difficulties there. See everyone jumping on. Good to see. And our mission today is transform personal finances and quality of life by creating passive income streams through real estate investments. So what does that mean? Well, Seth and I have been working together in the New Jersey market here for 10 years to find good investment opportunities, good real estate investment opportunities. We started with residential and grew into commercial and apartment buildings over time. And we also both read Rich Dad Poor Dad and recognized that the tax system is actually unfairly set up to benefit real estate investments over really any other type of asset class. So we, the light bulb went off in our head. We said, okay, wait a minute. If we're all playing by one rule, and that's the tax code, then we need to understand how to beat the tax man, pay less taxes, keep more of our money, and real estate's an amazing class for that. So Robert Kiyosaki says the moment you make passive income and portfolio income part of your life will change. And there's me working with one of our passive investors. If you haven't read Rich Dad Poor Dad, check it out. It's a great book. Really helped us understand how wealth works, why the 1% get richer, and why a lot of the rest of us work harder and harder to create wealth. So we're all about helping our investors build wealth. We work with small investors getting started. We work with multimillionaires looking to diversify their stock portfolio and get better tax write-offs. But I'm going to explain how a little bit we got started here. We established our business in 2013, and we have done over 250 transactions together, Seth and I. And I actually started as a realtor, and Seth was one of my customers, and he was submitting very low offers, and the realtors don't like buyers of low offers. So actually I was one of the only realtors that loved working with him, and Seth was stealing properties. I learned a lot from him, learned a lot from other investors. And together we bought a 6-family, we bought it, renovated, refinanced our money back out, and grew from that point, raised more capital, developed a management company, got to about 100 units over a 5-year period. And we learned quality over quantity as well. And we developed now a nice syndication business where investors, passive investors, whether they're invested in stocks or bonds, or maybe they have other real estate they're tired of managing, get invested passively in real estate into bigger apartment buildings that produce better cash flow, better benefits without having to do the work or the due diligence behind the scenes to find these opportunities. Seth, you want to talk a little bit about how you got started?
Sure. Thank you, Aaron. So as Aaron said, he was my realtor, and before that I was in Manhattan. I had a different business, more of a family type business with my brother, and I sold that business. It was a healthcare business from 2003 to 2009, sold it in 2009, took a year off sort of as a consultant for that new company, and during that time I read that same book, coincidentally in the same year as Aaron read it, Rich Dad Poor Dad, and it changed my whole mindset on how to handle money and invest my time and build a financial blueprint for myself and for my family. So basically, I started in real estate in 2010. I met Aaron. He was one of the few realtors, really the only realtor who would entertain all of my offers and questions and other things. And we started doing business together as well. After selling me some properties, we joint ventured. As Aaron said, we realized we worked well together. And then we started bringing in other people from a financial standpoint to invest with us and help them invest while we did the work and built the portfolio and allowed people to take advantage of owning real estate with us because real estate is one of the few asset classes that allow great tax benefits, depreciation, as well as cash flows and allow you to build wealth. So we've been building that whole business model for about 8 years now. And at this point, I'm more in the operations. I manage the contractors. I manage the management company. I work with Aaron on the strategic direction of the company. And Aaron spends most of his time building the brand and working with investors and seeing if it's a good fit for them to come in for future investments.
All right. Thank you, Seth. All right. And that's absolutely how it works in any business. You always want to partner out your weaknesses. Seth is amazing at operations. And really our secret weapon is also Lena Delgado, our property manager. We're going to talk more about how important property management is in this webinar. We're going to explain how real estate is different than stocks in that it's more management intensive, but you can also control the asset more, see your money actually making a difference in inner city areas, and ideally beat the performance of the stock market as well, also because of the tax benefits. So we're going to break into that today. We have about a 60-minute presentation from everyone, and we're going to explain how you can diversify your stock portfolio into real estate, have the same experience as investing in stocks, where you don't have to do all the work. It's a passive investment. You get a quarterly cash flow check, quarterly financials, monthly updates where you learn how we're repositioning the apartment building our investors invest in. And so we're going to talk about that today. Why do people invest in apartment buildings in New Jersey? Why Seth and I prefer the New Jersey market, and why our investors love investing in New Jersey apartment buildings. And number two, why do people prefer a syndicate investing? So this is explaining how we help people break into real estate, getting started. Small investors, big investors, people get started with a $30,000 investment into a multi-million-dollar building. And that's really how we help people break out of the volatility of the stock market into something more tangible and long-term and predictable, which is New Jersey apartment buildings that are professionally managed. Number three, why do people value PCG service? So, we're going to talk about, again, how we help investors recognize that there's other options besides the stock market. There's other things you can do, even with your IRA. You self-direct your IRA into real estate. We'll touch on that. And but let's dig into it here. Let's talk a little bit for a minute about the corona. Okay, we're all probably tired of this by now. It's something that certainly had an impact on the way we live our lives, right? We don't really have to go over it, but for the most part, we do recognize that single-family homes, really kind of took a hit, and actually they're back. They're on fire right now. Seth and I flip properties. We have a residential division. That's not what we're talking about today, but that is an important part of our business. It creates great profit for our company and for our investors in that space. And also that area was hit a little hard, but now it's coming back with a lot of strength, and we're actually having bidding wars on our properties. We just sold a property, renovated it, got it under contract with an end buyer for top price, the asking price we had on the market. So, that's a great part of the market, but single family homes and flipping houses is very precarious. It doesn't produce cash flow as apartment buildings do. So we actually prefer apartment buildings. Even during these tough times, we've had about 90% collections on our buildings. Okay, so during these tough times, a lot of people are saying, well, all my asset classes or whatever stopped producing, but apartment buildings actually did continue to produce cash flow here because we keep them well managed, and we have our in-house management company, which is really the competitive edge that we have over other investors that are in syndications that are buying apartment buildings. I'm going to touch on self-storage. It is an interesting space. We're looking at self-storage, but that's really an area where it's a big growth area, and we do look at opportunities there. Office and industrial is not a good area to invest right now. Office is becoming less and less necessary, office space, and industrial. There are warehouse demands, but we are really not in the space of industrial real estate. We try to stick to what we know, and what we do best is apartment buildings and single family houses, so multifamily residential and single family. And retail is another space that's very soft. Online shopping, Amazon, you can order something, it arrives the next day, sometimes same day. You're just not going to beat that with a storefront, so that is an area that we do not invest in either. Hospitality and senior housing, we actually like that a lot, but that's a very there's a little more red tape with that section, and also there's a lot of institutionalized money investing in that space, so therefore that props up prices. So we really prefer small to mid-sized apartment buildings within an hour of Manhattan, and we're going to explain that why we invest in that today. So this a strategic way forward here with the pandemic. Obviously we don't know what tomorrow holds. No one has a crystal ball. But what we can plan for is, hey, what are asset classes that people need, whether the market's up or the market's down, whether unemployment's high or unemployment's low? What do people always need? They always need a roof over their head, and they need an affordable roof over their head. I'm not talking the fanciest real estate in the block, Class A real estate, waterfront. That real estate's not a safe investment during tough times. However, we focus on middle of the road, Class B and Class C real estate. Not the fanciest, which is Class A, not the bottom rung of real estate either, which is Class D. That's also a very difficult space to make returns in. So we've learned this the hard way. We've bought all different types of real estate throughout New Jersey, And we've recognized you want middle of the road apartment buildings. But listen, if you're looking to invest in a syndicate, if you're looking to diversify your stock portfolio into real estate, which is the topic of today's presentation, then the first thing you want to be doing is educating yourself. So good work. You've made to this webinar here. We're going to help educate you on why we invest in New Jersey apartment buildings and why that's our preference. Maybe that's a fit for you. Maybe it's not. But at the end of the presentation, at least you're going to understand one avenue that does make consistent profits in real estate. And that is the most important thing, to always be educating yourself, but also working with experienced professionals, right? A lot of people in real estate say, hey, my friend wants to get started. My wife just got her real estate license. She's learning about what a comp is, what rent is. And, my buddy is trying to get into the contracting business. So we're going to team up and start flipping houses. The problem there is no one's experience. It's all about experience, all about making those mistakes, taking your licks, knowing what works, what doesn't work, having those people in place to run a good, strong, consistent operation in real estate. And that's what Seth and I work on day in and day out and have achieved in New Jersey. So always take it in consideration when you're reviewing an asset to invest in, a company to invest in, a partnership to invest in, then what's your degree of risk? Are you trying to get the fanciest real estate with pools on the beachfront that goes up really fast and down really fast? Are you going to do new construction of high-end real estate? Are you going to invest in the bottom rung of real estate that looks great on paper, but might be tough to actually collect rent, and there's a lot of cost to it? Or in our opinion, focus on the middle of the road real estate, location. You can make money in a lot of markets, but you want a market that's near a hub that's going to have consistent demand. We don't buy in Manhattan. We don't buy in New York City. We buy around New York City on the New Jersey side. In our opinion, New York City is always going to hold a demand. It's one of the largest, most powerful cities in the world, and people need to live within an hour of New York City. But they don't want to pay what the boroughs are demanding these days. So they move to New Jersey. They moved to Newark, they moved to Patterson, they moved to Jersey City, they moved to Elizabeth. So we focus on these markets. You want to look at the history of your market and understand why you're investing in that market. What's the long-term strategy? And also, what's the market done for the last 5, 10, 15, 20 years, right? And that tells a story as well. So here in New Jersey, we focus on the strength of the market. We see that wages have rose consistently, rent has rose consistently. We're buying a building now in Patterson, New Jersey, and the rent has gone up $500 overall in just the last month. Rent on our properties has increased during this pandemic. So our rent roll's gotten larger. Rent's gone up in our New Jersey apartment buildings during this pandemic. And that is a testament to having a recession-resilient asset, right? As stocks go up and down, our rent continues to build and continues to be collected. So New Jersey is a highly skilled workforce, okay? We rank number 1 in education, number 3 in median household income. There's a lot of capital here. So a lot of syndications, that's what we are, we're a real estate syndication. A lot of syndications will locate themselves in New Jersey or New York City because there's a lot of wealth here. There's a ton of wealth in this area. We're well educated, we work hard, we make a lot of money, and we like our toys. And New Jersey, New York, there's a lot of wealth, a lot of highly educated people, and that's great to raise capital, but then they invest in buildings outside of this area because, quite frankly, it's hard. The hardest part of our job is finding a good discounted apartment building in New Jersey. And we're going to break into that in a second, how we do that. But basically, a lot of syndications are raising capital here, moving it out of state, hiring a third-party management company, hoping they do what they say they're going to do. And, that is a recipe for trouble. So we don't do that. We buy in-state. We raise mostly in-state, although we have investors all throughout the nation. And but most of our investors really like investing in cities they grew up around, making a difference in Newark, making a difference in Patterson. If you grew up in New Jersey, these cities need investment and they need improvement. They need focus. So that's what we do here at PCG, one brick at a time. State is home to 20 Fortune 500 companies, number 1 in drugs and pharmaceuticals, number 2 in direct foreign investment. So a lot of activity here in New Jersey. That's why it's so darn hard to find a good deal. So why do people invest in New Jersey apartment buildings? Continued here, legal tax shelters. Okay, all real estate offers legal tax shelters, but in New Jersey, we invest with an equity strategy, meaning that our cash flow is about equal to the tax depreciation that the buildings produce. So therefore, our investors pay very little income tax. You don't understand exactly what I'm saying? We can break that down further. If you're qualified to invest, we have further information about how that works. People want low risk investments, right? So buying larger properties allow smaller investors, say with $30 or $50 or $100,000 to invest, actually break into a building, own part of a building that may be $3 or $4 million, maybe 25 or 30 units. And that's a safer investment. Okay, if you own a 2-family and you lose a tenant, you lose half your income. If you own a part of a 25 unit and you lose some tenants, you can still make positive cash flow on the building. Larger buildings produce better returns, and they're less hindered by repairs and vacancies. Not to mention, when you're within an hour of New York City and you're near a train station that allows your investors to commute into New York City in less than an hour, then you're going to have consistent demand to rent your units as long as they're well maintained and professionally managed, which is exactly what we do here. As long as they're well maintained, professionally managed, we tend to have lines out the door to lease our units. And the last problem we have is finding a tenant. The hardest part, again, is finding a good opportunity in this high demand market. So as I explained, well-managed New Jersey apartment buildings do fare well in recessions. We've seen that. We've proven that in the last few months. We continue to prove that as rent goes up. We turn over units quickly in this time. We're not having delays on leasing open units. And, there's a recession going on. There's a pandemic going on. So this continues to be an asset class that performs during this difficult time. All right. And that's why investors enjoy us. We work with over 30 investors. We have 22 more coming on right now. A lot of our investors put their earnings back into buildings with us. And we offer a long-term investment. There are multiple exit strategies we'll talk about towards the end of this presentation, but a lot of our investors look at us as a long-term investment, and that's a great option for them. They can fund their college education for their children, weddings, travel. Okay, we're going to get back to that one day. We're going to get back to traveling and vacations. And, people are looking to not take all the risk, not do all the work, but get the benefits of real estate long-term as well. All right, we do the buy, renovate, refinance strategy. We're going to break into that, how we do that, why we do that here. And that allows our investors to get a large lump sum capital payout every 4 years or so, but also remain invested long-term if they choose to, and have a great tax strategy long-term. We're going to break that down exactly how that works. So as we were saying, the larger buildings are actually lower risk. Okay? It's lower risk to own a 25 or 50 unit or 100 unit building, even if you own a small share of it, because that's professionally managed. It's professionally investigated and reviewed by Seth and I and our staff, and a number of other professional inspectors and accountants, attorneys, title companies. So this allows the buildings to be well vetted, and then of course well managed long term. And now let's talk about debt for a second. Okay, so debt is a tool we use in real estate to allow us to get better cash flow. But debt is something that you don't want to be on the hook for. You don't want to personally guarantee debt. Now, if you and a few of your buddies pulled capital together and bought a piece of real estate, that's a good strategy, but you're going to probably need to get a mortgage to actually cash flow on that real estate. So in that case, you'd have to personally guarantee a mortgage. That means you're on the hook for the mortgage, whether there's foreclosure or bankruptcy or anything, you're personally guaranteeing a loan. And that is a risk that we make sure our investors do not have to take. Seth and I will personally guarantee that mortgage. Our investors do not have to personally guarantee the mortgage. That allows the mortgage to get great terms, right? Because as Seth and I put our name on the line, we're worth millions of dollars. So banks say, great, we're going to give you better terms, lower interest rate, less closing costs, because you're taking more risk, Seth and Aaron, and you're worth a lot of money. So banks like that. So we personally guarantee the mortgage. Our investors don't have to. And that's a huge, huge benefit that I just want to make sure all of our investors or potential investors understand, that when Seth and I are personally guaranteeing a mortgage, we are in it to win it. That means we are confident in our performance. We're confident in the asset. We're confident in the long-term strategy to buy, renovate, refinance, repeat. And it's shown by personally guaranteeing a multi-million-dollar mortgage. So as I was saying before, we want to focus on New Jersey markets that give you commutability, easy commute into New York City. Millennials are popular to lease our units. We give them the whistles and bells they're looking for, stainless steel appliances, granite countertops. Without spending too much money, we can make a nice, appealing unit as we turn over units, improve them slightly for top dollar. Sometimes less is more when it comes to renovating apartments. It's not like we're flipping a house. We're not going to put in the best of that and best of that. We're going to make sure the quality of material fits the quality building and the tenant we're trying to retain. So because of that, we focus on Newark, Passaic, Patterson, and well-managed properties there. Well, mismanaged properties when we buy them, but well-managed properties once we own them. We turn them around. We find more ways to make money on the property. We lower our expenses. All right, we're buying a property right now. There's a supervisor on payroll. He gets paid way too much money to take the garbage out to the curb, so we may make changes there. There's about 10%, the rents are about 10% below market value. So there's room to negotiate the leases up over time to market value. So that's what we look for, mismanaged apartment buildings where we can lower the expenses, increase our forms of income, maybe find storage in the basement we can charge for, parking. And overall, that's why people prefer syndicated investing, because we manage the property from A to Z. We don't just call a plumber when a pipe leaks and collect the rent, though. We are repositioning apartment buildings. Okay, so what does the repositioning apartment buildings mean? Well, exactly what I just said. We make more net profit from the building. That means we lower our expenses and increase our forms of income and how much the rent roll is. And that allows us to make a better net operating income on the property. So, you can look at a piece of real estate like this, an apartment building, as a business, right? First of all, you want to invest in a business that has more customers than less. So you want 25, 50 customers. That's better than a 2 or 3 unit, right? So you want bigger properties. Secondly, you want to lower your expenses and increase your income so the business is worth more money. That's exactly what we do to the real estate. And then it's worth more money because it makes a better profit. And there's also capital improvements to it. And that allows us to refinance and harvest that equity we've forced into the property and split that up with the investors. Okay, by syndicating the pool together, by managing the property day to day, we remove a lot of the risk that investors would normally be taking if they're owning a building completely themselves or at the mercy of a management company they're managing, or of course managing a building themselves. Okay, a lot of our investors are active real estate investors that manage their own real estate and end up investing with us passively, not doing any of the work, but actually making better returns with a passive investment in the buildings that they're running around managing day to day, because it's bigger properties and it's better management. So people like the idea of tapping into expert real estate knowledge being lifted up above the pitfalls, and acquiring this expertise has taken years. Okay, I see we have a question here. I'm going to hold off till the end to answer any questions, but please put your questions as we go along. And people also value their free time and have no interest in securing the complex financing. So we talked about personally guaranteeing that mortgage. Seth and I have used our years of banking relationships to get really good terms on mortgages. And let's just talk about interest rates for a second, right? Interest rates are phenomenal right now. We're buying a property at 3.75% interest, which is phenomenal, right? That's a few ticks above inflation, really. So historically very low interest rates, and that's another reason to take advantage of this market right now with syndicated apartment buildings. It's a very hot space. The reason it's so hot is because interest rates are low, and quite frankly, the price of the real estate is not that expensive. If you can find a good deal, it makes money right now because interest rates are low and rents are high. So we find a mismanaged apartment building, we improve the performance of the building, we force equity into the building. That's called forced equity, by creating a better net cash flow. And then after 3 to 4 years of doing that, we do a refinance. We're going to harvest that equity, get a larger mortgage amount that's going to be paid down over the years by the tenants. But by doing the refinance, we get to split up a large amount of capital, our investors and us in the project. But if you do not exit the investment, that refinance capital is tax-free. Okay, we're not selling the building. It's not cash flow. We're refinancing the building. The building's worth a lot more after we reposition it, and we're harvesting that growth in value and splitting that up amongst the investors. And that's a great way to pay all the investors and ourselves without losing the building, which is producing cash flow and tax benefits quarter over quarter, and without also getting taxed on the sale of a building, right? Or getting a cash flow, which is taxed and written off with tax depreciation. So every 3 to 5 years, we do the refinance, okay? And that allows our investors to harvest that equity, take part in that equity growth. And so how do we find the opportunities, right? So that's the hardest part. We will invest $10,000 in a month sometimes to find an opportunity. A mismanaged apartment building is hard to come by in New Jersey. We have lots of relationships with investors, with landlords. We have lots of relationships with brokers. And this allows us to find off-market opportunities that normal investors wouldn't be able to find, right? They're not sitting on LoopNet. They're not sitting on the MLS. These are off-market opportunities, generally below market value. We never pay $20 for a $20 bill. And we have about 10,000 people in our network, real estate professionals, investors, brokers, wholesalers. We don't sell education. We don't sell books. We don't sell boot camps. We're strictly in the business of finding discounted apartment buildings in the North Jersey market, managing them to a T, and executing a refinance strategy every few years. All right, we've secured funding on over 250 properties, about $40 million. We currently hold a $10 million asset. We actually have about 86 rental properties. I'll have to update this presentation here. We are always buying and selling assets. And we're taking on another 25 as well towards the end of this next quarter here. So PG takes on the risk of repaying the banks. And as I was saying, that makes sure we're hyper motivated to make sure we hit those marks on cash flow, hit those marks on the reposition, and allow our investors to make the returns perhaps even better than we're projecting, which we've done in the past. So Seth, you want to take it over?
Sure. Thank you, Aaron. All right. So part 3 of our presentation is why do people value our service, People's Capital Group service? And the short answer is that we do all the work for the people we work with. And the people we work with, a lot of them are career professionals, doctors, dentists, even realtors, attorneys, carpenters, even retired people. Could be anybody, but people that have a job or have a passion in life that they're taking care of, that's taking up most of their time, and they want to be in real estate, but they don't want to spend the time that it takes to own real estate successfully. Somebody has to manage the real estate, and there's a lot of parts from beginning to end. So to be a successful real estate investor, you need good management. It's very time intensive, as Aaron said. So that's why people come to us. As a side note, they like our business model. We're very aggressive, calculating. We try to set a high standard for everything we do. So if we go to the next slide here, we're going to get into some of the details of what we do and why people entrust us with their investment. Okay, so it all starts with finding the deal. And again, that's something a lot of our clients that we work with, some 15 or 5 to 10 years, they don't want to spend the time doing it. And it takes a lot of time. It takes money. You have to cultivate relationships with realtors, with landlords, with other real estate professionals, and including marketing. So we spend a lot of money every month marketing to different properties, different landlords, trying to find good deals and trying to create opportunities. And good deals don't just come to you. A lot of our clients tell us they've tried to find deals, they've done their own marketing, they've talked to realtors, and they kind of gave up because, again, the good deals have to be created. They take a lot of patience, and that's what we do. So we spend thousands of dollars every month marketing to landlords, building relationships. It can take months, it can take years to negotiate a great deal, and when we do that, we share those deals with our investors. And we look at a lot of properties. It says here close to 400 properties every month. That does fluctuate, and we don't go out to 400 properties. If we drove out to 400 properties, there wouldn't be enough time in the day. But we look at them online, and we evaluate deals very quickly. We've gotten good at evaluating deals, and we can evaluate a deal in 3 to 5 minutes. The ultimate goal here is that we want to create passive wealth for our investors and for ourselves, and we want to grow that wealth together. So I'm going to go to the next slide here and talk a little bit about what we do in a nutshell, the actual nuts and bolts. So the goal, as Aaron was explaining, is to create, take a piece of property that we buy with our clients and make it worth more 5 years later and 10 years later and 15 years later, and just keep adding value to it so that the value of the property increases and we can share it together with our clients. And the way we do that is by increasing the rents year over year, month over month, as leases come due. We want to maximize the rent. We also have to know beforehand, and we do this during our due diligence period. We do some due diligence with the town, and we find out if there's rent control in New Jersey. Rent control does exist. It's delegated by Trenton, and then it's delegated out to each municipality. So some municipalities choose to implement it, and some do not, and some choose to implement it very stringently, like Jersey City, Union City. Some choose to implement it more relaxed, like Patterson and Newark. Well, Newark's now starting to get a little more strict. So we want to know that beforehand and know what we're getting into before we buy the property. And again, that's why a lot of our clients come to us, because they don't want to do that work. That takes time. Due diligence takes a lot of time and work. So again, as leases come due, one of the best ways to increase value to a property is to increase the rents. So we do that according to the law as leases come due. The flip side of that, just as important to adding value, is decreasing expenses. And we do that by separating out utilities in many cases. If they're already separated out, we try to find more efficient utilities. But a lot of the properties we buy, the landlords are mismanaging the buildings. In other words, they're paying the utilities in many cases, the heat and the electric, or one of the two, and that drives down their net profits. So again, as leases come due, we want to bring in new tenants, but first we want to separate out the utilities. So we're going to bring in our contractors and separate out those items. So when new tenants come in, they're now paying their utilities, and the net profit to the landlord, in this case us and our clients, is that much better. So we do this over the course of 5 years, and we want to generate cash. We want to generate cash distribution on the refinance, so not just the cash flow, also not just the tax depreciation, as Aaron was saying, but the third part of how we and our partners get paid is we do a cash distribution every 5 years on the refinance. And that's tax-free money. So taken together, the cash flow, the tax depreciations, and the capital distribution from the refinance creates or can create a tax-free income to investors as long as they don't sell their share. Okay, and tax-free, of course, is a better ROI. Okay, another important thing that we do, and one of the reasons people like our service, again, is we're very aggressive. We want to set a high standard for everything we do, from dealing with tenants, screening tenants, communicating with tenants, being fair but firm with tenants to make sure they pay their rent. We also want to be very professional and set a high standard with our contractors, set their expectations on what we're expecting. We want to manage their results and make sure they're doing quality work so that our tenants are getting quality apartments. And we want to build good relationships with our contractors, but that comes with time. And again, everything else, we want to set a high standard. So realtors, attorneys, banks, we want to set the high standard and make the experience for ourselves and for our investors and everybody we work with a good one. Okay, we have low vacancy rates. Before the pandemic, we were close to 95 to 99% collections every month. As Aaron said, it's taken a bit of a hit. It's closer to 90% now, but we think it's going to recover rather soon, and we're already showing signs of doing that. Okay, another important thing is managing our own properties. We have our own management company, as Aaron said. Now we only manage our own assets because we want to focus the attention of our management company on our investors and our own properties and our assets, and not get distracted by other properties, because we will get a better return on our own investments and share that with our partners if we're not distracted. Okay, and then lastly, just a consistent cash flow. Very important to have and create consistent cash flow and passive income stream to our investors. So at the end of an investment, We also want to make it easy. So another thing people like about us is it's easy to either exit or remain in the investment. The typical investment is 3 to 5 years, closer to 5 years. And at that time, investors have a choice. They can either stay in the investment for another 5-year term, or they can pull out their principal. In either case, if they stay or not, they keep their profits. But if they stay in, they defer their taxes, and they have the first opportunity to continue investing, because all of our investments are first come, first served basis. Okay, and then just on the last slide, I think we have one more here. Okay, so we've worked with dozens of investors. As Aaron had mentioned, we've been in business almost 10 years, and we are in a growth stage right now, so we're looking to bring in more qualified investors so we can grow our portfolio and share the opportunities that we find with a new people. But we also keep in mind our existing investors, so they tend to have first opportunity. But there is a lot of openings coming up as we grow, and there may likely be some new slots. So if you're interested, reach out to us, and we can see if it's a good fit for both People's Capital Group and for yourself. And I'm going to hand it back to Aaron here.
Thank you, Seth. All right, I'm going to go through a couple quick case studies to give some of our listeners and viewers an idea of exactly how this works, and hopefully that'll answer some of your questions as well. So here's a 5-unit in Newark. This is a smaller property, a smaller example of a piece of real estate here, but it's a good example of buying in an area that continue to improve in value as we continue to improve the cash flow of the real estate, but more so just buying in the right area, which is what we really focus on. We try to buy around the cranes in these cities. We bought around Rutgers University in Newark about 10 years ago when people said, why are you investing in Newark? That's a crime-ridden city. Well, these assets have exploded in value, and not only do they continue to make cash flow and tax write-offs, but they're worth a whole lot more than we paid for them. And we're seeing the same thing happen now in Paterson, New Jersey. We saw that happen in Jersey City. We saw it happen in Hoboken. The indications are there. So if you buy in the right areas, you can't just buy anywhere in these cities, but if you buy in the right areas, you can do very, very well as long as you execute the right management strategy. So here's a great example. We bought this property for $110,000. They were asking $130,000. This is a storefront with 4 apartments above it. And so right off the bat, we captured about $20,000 in equity, able to get about 15% off the list price. It's very important for us to do that. Our job is to find a great deal, a discounted price that needs improved management. And this one checked off all the boxes. The renovation was light. Okay, the less you swing hammers in real estate, the less construction you do, the less risk you have. So we don't buy properties that need a ton of construction. That's not our specialty. We buy mismanaged apartment buildings. They probably need a paint job. They probably need some new appliances. They probably need some fresh flooring, but we're not adding a level. We're not doing any type of major development that requires architectural drawings or even a permits often. So once we did cosmetic renovations to the property, it was then fully leased out and cash flowing, and we had it appraised 1 year later, and it appraised for $310,000. So we're into it for 130 plus 30 in renovation plus maybe another 30 in holding and closing costs. So, we'll say 190, 200, and we're able to refinance and pull out, 70% of 310,000. So we were able to make back our entire initial investment and some on top. Our initial investor got back his entire initial investment at that time, continues to cash flow on the building to today, continues to earn tax depreciation on the building to today. And I think we actually refinanced again in 2017 and split up another lump sum of capital. So really, real estate is bought in the right area, managed properly. Over time, the value of it continues to grow. And as long as you safely harvest that equity, don't over leverage yourself, then you can do very well with real estate that's well managed in the right areas over time. It's very forgiving, and it has a lot of benefits like the cash flow and the tax depreciation. So here's another larger property, a 25 unit. This is actually in South Jersey. Now we recognize with this one that we want to only buy within an hour of our office. We also recognize that South Jersey doesn't hold the demand that North Jersey has, but we did very well on it nonetheless. We paid about $1,075,000 for it. which was $125,000 below the asking price. So we had a good relationship with the broker, and we were able to work the price down as the broker vouched for us as good real estate investors. Sellers will give good real estate investors that have a good relationships with brokers. Those sellers will give those investors discounts, and that's what Seth and I are able to obtain with our relationships and our track records in this industry. So we got a good price on it. We were able to negotiate about 12% off the list price, and we were able to then obtain a loan at 75% of the purchase price, 4.5% interest rate. Interest rates were higher then, right? It's 2014. So we were we're now at 3.75. So, and interest rates are getting even lower depending on the property and the size of the loan. So our private investors came in with $100,000 each. There was 4 private investors. We ended up doing a 60-40 split on this property. And it's not always that clean. Sometimes we have investors at $30,000 and other investors at $300,000 on this property we're doing right now. We have that exact example. And in this case, though, each investor came in with $100,000 each. We raised $400,000 to 60-40 split, and then we ended up selling the building about 2.5 years later. And we made a nice profit of about 26% on the investment, sold for $1.35 million. We were able to take the cash flow from the building, put it back into the renovations of the building, and then sell the building for a nice profit over a 2.5 year period. So we initially projected about 9.5 cash on cash return annualized to our investors. On this property, we were able to achieve 11. So we predicted 9.5 annualized cash on cash returns. We hit 11%. So it's really about under promising and over delivering. And that's why a lot of our investors, the majority of them, reinvest the returns of People's Capital Group or just stay invested long term with us, because once we buy the building and execute our value add strategy, it really becomes a nice cash flow machine with tax benefits and long-term equity cash outs. And it really, over time, real estate can just be the gift that keeps on giving. If you have an IRA, if you're invested in the stock market with your IRA, you can self-direct your IRA into real estate. I'm not going to break into this too much right now. I actually have a presentation not this coming week, but the week after, Tuesday night at 7 p.m. Eastern time. So if you do want to check that out, if you really want to learn how to self-direct your IRA into real estate, sign up for our next webinar. In fact, you just go on our website. We also have recordings of that webinar as well from the past if you don't have time in a week and a half from now on Tuesday night. But essentially, if you hire an IRA custodian, we can help put you in touch with a few of them. There's many of them out there. Our podcast often highlight with them. We just did one with UDirect IRA on Friday. Great company there. So you select an IRA custodian. It's not very much money. You can self-direct your IRA into that custodian, and then that custodian can move that into an apartment building with People's Capital Group, and we can pay cash flow checks back to your IRA custodian and the refinance capital as well, and build your IRA faster, make it stronger, and also have your IRA actually improve inner city areas where, you know, a lot of times your IRA is just sitting in an index fund going up and down with the stock market, not actually making a difference, maybe in some cities that you care about, like Newark and Patterson and Jersey City. And so people like that, the tangible effects of their IRA or just any stock investment, and moving that into a tangible piece of real estate, be able to drive by it, show your spouse, show your friends, hey, see that 25-unit apartment? Yeah, I own a piece of that. It's going well. We improved the building. We made it family friendly to live there. We made it smell better. We made it look better. We make it safer to live there. And now it's a piece of real estate I can be proud of. And not to mention, it makes me a cash flow check every quarter and gives me tax benefits. So if you want to learn more about how to self-direct your IRA in real estate, you can check out that webinar coming up next week, or you can go to our website, People's Capital Group. I'm going to quickly talk about 3 different types of investors here that we work with, just to explain how we work with investors and how you can see yourself in their shoes, essentially, if you feel like this might be a fit for your investment needs. So we do work with accredited investors. Okay, a high income investor is an accredited investor. They tend to have large stock portfolios that make small stock dividends. We produce cash flow through apartment buildings here at People's Capital Group. And cash flow is similar to dividends, except dividends are taxed, and cash flow in real estate can be written off with the tax depreciation that the building produces. Okay, since our investors are owners of the real estate, they don't have to do all the management of it and take the risk with the mortgage, but they do own part of an LLC that owns real estate. And that gives them all the tax benefits and the cash flow of the real estate. So that's a great benefit to not have to pay taxes on that cash flow where dividends are taxed. Long term, real estate is, in our opinion, more predictable. Long term, we've seen real estate to be more recession resilient. It goes up and down much more slowly than stocks. And we see through this time that as stocks are very, very volatile, real estate continues to actually cash flow and be more recession resilient and less volatile. So people look at real estate as a less volatile option than the stock market. We also work with a lot of active real estate investors. They might actually own real estate. They might be running around managing them day to day, or managing a management company and hoping that they're working with transparency and integrity. And some of those investors come out of an investment and have liquidity. And they say, you know what, let me try investing passively with People's Capital Group. That way I don't have to personally guarantee the mortgage. I don't have to deal with all the headaches of being a property manager. And those investors actually tell us that they make better returns investing passively, or equal to the returns, investing passively with us, not taking all that risk and doing all the work, having the taxes filed nicely for them at the end of the year. Tax time is very easy for our investors. So we make it a nice process, a nice experience investing with us as well. So a lot of active investors in the industry say, wow, I like this experience of just being a completely passive investor, learning what's going on, reading the monthly updates, getting a lot out of these guys and educating, yourself along the way. But not doing all the heavy lifting that's involved in real estate. So finally, the third type of investor we work with is an IRA investor. This is someone that's going to self-direct their IRA into real estate. Again, you can check that out for more information on our website, peoplescapitalgroup.com. But it's pretty simple. You hire an IRA custodian, you move it into that custodian, and that custodian can move it into an asset with People's Capital Group. You could do a couple different things with it. You can invest in a flip. You can invest a little here, a little there. There are rules, so your custodian will guide you. And again, we feel it's more predictable long term. We feel for a retirement account, it's a safer place to diversify some of your IRA into real estate. Never all of it. You always want to be diversified. And again, we do see it's more recession resilient. So also people really like putting their IRA in inner city areas and seeing a difference with that capital. So that's about it for today, everyone. We have a number of investors here, client satisfaction. Of course, we worked with investors for 10 years now. We have over 30 investors that are reinvesting with us time and time again. And we've created a nice system here where investors can diversify out of the stock market and into real estate safely, not having to do all the heavy lifting of managing the real estate. And again, make a difference in these inner city areas. So if you know Newark, if you know Patterson, there's areas we're very bullish on these cities, and there's areas we're not. So this allows you to make a difference with your capital, whether it's in the stock market or in real estate. But this is about diversifying out of the stock market, getting away from that volatility, and getting more control over your capital. Actually knowing where your capital is, knowing what it's actually doing, seeing the tangible differences made with your capital in New Jersey cities here that continue to hold demand through these tough times, this pandemic going on. Rents are going up with our buildings, collections are strong, and that's a testament to just the advantages that real estate offers time and time again. We've seen it. It's a proven method. We've really perfected it here at People's Capital Group. So I invite you to fill out the application form on our website. If you feel like you're a fit for People's Capital Group, our minimum investment is $30,000. But if you're a sophisticated or an accredited investor, if you're not sure what that means, go to peoplescapitalgroup.com. Here's our website, peoplescapitalgroup.com. You can learn more about our business there. You can read up more about us as well. And then you can fill out the qualification form if you're ready to take the move to real estate, diversify that portfolio from the stock markets and get rid of some of that volatility and get something that really produces consistent cash flow, tax benefits, and large capital payouts over time. So if you want to learn more, go to our website, peoplescapitalgroup.com. I'm actually going to put the link to fill out the qualification form in our chat. You can click that link, you can fill out the qualification form. We don't work with everyone. You do have to qualify. The first step is filling out that form, and we do have limited spots. We work with investors on a first come, first served basis. So really the hardest part is finding a good opportunity. We do have one of those out to our private qualified investors right now. So I'm going to put that link in the chat. I'm going to read our questions here. Okay, Jose Rivera says, can you give me a ballpark figure of what a $100,000 investment would yield? Absolutely, Jose. So a $100,000 investment would historically yield here at People's Capital Group we've achieved about a 10% to 11% cash on cash return each year when annualized on our investments here. So if you invested $100,000, you'd expect to make about a $50,000 return over a 5-year period. Okay, that's a 10% cash on cash return. Okay. Oh, Diane Ling, sorry. Oh, for some reason, Diane, you came up as Jose. I'm not sure why. So, okay, good question though. Okay, Yvonne, good to see you on here. And your question was, with interest rates just now below 3%, are you looking to get even better than 3.75, as you mentioned? Yes, Seth and I are always looking to get the best banking terms possible. You have to understand that just because you see interest rates below 3%, that doesn't mean that commercial real estate loans are below 3%. You may be looking at residential loans. You may be looking at Fannie Mae, Freddie Mac commercial loans. The building we're buying right now does not qualify for a Fannie Mae, Freddie Mac loan. Therefore, we do have a little bit higher interest rate, but historically 3.75 is very low. And also, depending on the type of real estate, it can go lower. And we're always working to get better banking terms. All right, so let's see here. All right, thanks, Yvonne, for listening here. I'm going to go ahead and I'm going to share that link to fill out the qualification form. It's good to see some of our qualified investors on here. It's good to see some new investors as well. We see a lot of demand to get out of that stock market and a lot of frustration with the stock market. So that's it for today. I'm Aaron Fragnito of People's Capital Group. Hopefully I answered everyone's questions. I'll put this link in the chat. Fill it out to move to the next steps. Enjoy your day.